Thank you for attending our webinar on Social Security optimizations. Make Social Security the cornerstone of your retirement plan. I'm Nolan Baker from America's Retirement Headquarters, and our mission is to educate all Americans on the importance of financial independence. This course is taught by licensed professionals working with America's Retirement Headquarters. You can visit us online at americasretirementheadquarters.com, or you can reach our office at 419-842-0550. Today's presentation is for educational purposes only and should not be considered investment advice. Always consult with an investment professional and tax professional before making important financial decisions. Advisory services are offered through the Retirement Guys Formula, LLC, a registered investment advisor. Securities are offered through Peak Brokerage Services, LLC, member FINRA and SIPC. America's Retirement Headquarters and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Today's learning objectives on the Social Security topics being covered are how benefits are calculated and earned, what fully retirement age is, and understanding the penalties for drawing early and/or the benefits by waiting. The working income tax trap for certain ages, how taxation works for benefits, side-by-side comparison of drawing benefits early or later, and the software that we use to optimize your plan. The power of Social Security is if we look at longevity, taxes, and inflation, all of these play into the factor, and it has the ability to combat the erosion effect over a 25 to 30-year retirement. What makes Social Security the retirement cornerstone you've been looking for are benefits are paid for life, they're continued for the life of the surviving spouse, inflation adjusted, tax efficient, backed by a government promise. First, let's see if you can answer this correctly. For an individual to be eligible for Old Age Survivor and Disability Insurance Program, the individual must earn how many credits? Answer A. You are automatically entitled to benefits if born in the United States. Option B. 10 credits or about 5 years. Option C. 40 credits or about 10 years. Option D. 66 credits or about 12.5 years. All right, do you have your answer locked in? The correct answer is answer C. So let's go into Old Age Survivor and Disability Insurance Program. And again, as we pointed out, an individual to be fully insured must have 40 credits or about 10 years worth of work. Once the fully insured worker gets to that point, they then have three options. They can take early retirement, they have full retirement age, or they can earn delayed retirement. Early retirement is going to be, for today's talking points, between the ages of 62 and 66. There's a 25% for life reduction in benefits from drawing at age 62 versus 66. Full retirement at age 66. And for today's discussion, we're going to consider FRA, or full retirement age, as age 66. Next, what you have is delayed retirement. Choosing not to receive benefits at your full retirement age and opting to wait, an individual is going to earn delayed retirement credits for each year beyond the FRA up to age 70. Again, in our illustrations and examples today, we're going to look at the people who are born from 1943 or later, and the delayed retirement credit is 8% per year. If we look at the lifespan of $1,000 a month primary insurance amount for a worker with a FRA of age 66, what you can see is that the benefit is 76% higher by waiting until age 70. If you have a question about today's presentations or your own questions on Social Security, you can email me at nolan@retirementhq.com. I'm also available by text message at 419-909-36 3828. Or during normal working hours, if you wanted to call the office, you can reach our office at 419-842-0550. Spousal benefits. Social Security optimization is most useful for married couples preparing to file for benefits. This benefit applies only if one spouse has a PIA that is less than one half of the other spouse's PIA at their FRA. In addition to your own benefit, filers also may be eligible for an extra spousal benefit if they're married to a worker who is eligible and has filed for benefits. Even if you don't qualify for your own benefit, you are entitled to a spousal benefit if your spouse is eligible and has filed for their own benefits. Next, let's see if you can answer this correctly. If you or your spouse collects a spousal benefit, the penalty applied to the fully entitled spouse is option A, 5% penalty for each year under the age 66. Answer B, no penalty. Answer C, it depends upon the substantial earnings test. And option D is the windfall elimination provision is applied. All right, got your answer locked in? The correct answer is answer B. There is no penalty to either spouse for collecting a spousal benefit. If we look at this, in order to determine if you qualify for the extra benefit from your spouse, number one, you divide the spouse's primary insurance amount by 2. Subtract the PIA from the amount to determine if you will receive an extra benefit from your spouse. Looking at an example of a husband and wife, both age 66, the husband's PIA is $2,400 a month, and the wife's PIA is $1,000 a month. Half of the husband's $2,400 is $1,200 a month. Subtracting the wife's PIA of $1,000 a month, that means there's extra to the wife of $200 a month. The total monthly combined income for the husband and wife in our example is $3,600. Next, let's look at independently entitled divorced spouses. To be eligible for spousal benefits in a divorce, you need to have been married for a minimum of 10 years, divorced for at least 2 years, the applicant is at least age 66, the applicant must be unmarried, the PIA amount must be less than half of the former's PIA, and the former spouse must be entitled to benefits. It works slightly different for independently entitled divorced spouse in a survivor benefit. In a survivor benefit, you still have to be married for a minimum of 10 years and divorced for 2 years, but what you can see is the applicant is at least age 60 or 50 and disabled, and the applicant did not remarry before the age 60. So when does the filing decision happen? New Social Security claimants in calendar years, and what you can see from this chart is less than 1 in 3 individuals filed for full retirement benefits at their full retirement age or later. Can you answer this correctly? If you collect Social Security benefits before the age 66, how much work income can you make in 2020 before the earnings test reduces your benefits? Answer A, the recent Jobs Act eliminated the earnings test. Answer B, $40,800. Answer C, $32,500. Answer D, $18,240. All right, got your answer locked in this time? The correct answer is answer D. So let's talk a little bit more about that. According to the SSA, the earnings test for the year 2020 is $18,240. In our example, we're going to take a look at an individual age 62 earning $60,000 a year of work income. We're going to subtract the $18,240, and there is excess earnings of $41,760. Now they're going to divide that number by 2, and so the annual Social Security benefit forfeiture is $20,880. Over the course of 4 years, the total benefit forfeiture is $83,520. If you have a question about your Social Security, feel free to shoot me an email, again at nolan@theretirementhq.com. You can text me your question at 419-909-3828 or call the office at 419-842-0550 during normal business hours, and one of our licensed professionals would be more than happy to chat with you. Now we're going to talk about the power of waiting. As we can see here in the highlighted section of drawing benefits at the age 70, the total income is guaranteed to increase by 76%. In our example, $2,651 a month more if the couple waits until age 70 to take Social Security benefit as compared to age 62. Keep in mind, these are hypothetical benefit amounts and are used for illustration purposes. Using the power of waiting, that $2,651 per month is $31,812 a year. Can you answer this correctly? For a married couple, both age 65, with a blended portfolio of 60% stocks and 40% bonds, in order to have a 90% probability of success funding the retirement goals over 30 years, what is the recommended safe withdrawal rate? And our source we're using for this is a white paper by Morningstar on the safe withdrawal rate. If you'd like to read the entire report, just simply contact our office. We'd be happy to give it to you. So let's see what you think the correct answer is. Answer A is 2.4% withdrawal rate. Answer B is 4% withdrawal rate. Answer C is an 8% withdrawal rate. And answer D is a 3.6% withdrawal rate. And if you have your answer locked in, the correct answer is answer A. I'd also note that past performance does not guarantee future results, and the Social Security optimization software does allow you to pick your own safe withdrawal rates. A lot of people ask us, Nolan, what's my number? What number do I need to have in order to be confident in my ability to be able to retire with a high probability of success? So using the safe withdrawal rate, what we can do is we can take and we can divide somebody's income goal divided by that number. And in our example here, this particular individual needs to have $1,325,500. And keep in mind, other factors such as investment fees and expenses are going to also impact your withdrawal rate. Next, let's look at historical Social Security cost of living adjustments. So since 1975, the Social Security benefit increases, while not guaranteed, have been automatic. And if you take a minute here and look at this chart, you can see some of the times, like in 2009 or 2010, there's not been a cost of living increase. And other times that been cost of living increases that have reached double-digit numbers. But the historical average over this time frame is 3.68%. That becomes extremely powerful when you add the stacking of the cost of living increase into the income growth. So in our example here, if we looked at the cost of living increases in the middle column there, years 2011 through 2019, again, age 62 to age 70, what you can see is that using that cost of living increase, it also grew by an additional 104%, assuming that you reach the benchmark year in 2011 at the age 70 in 2019. And the cost of living figures were calculated as declared by the Social Security Administration in those years. So there's extreme power not only in delaying benefits, but also when you factor in the cost of living increases and how they positively impact the power of waiting. Let's kind of look at a case study here. This is the power of Social Security optimization. What we have is we have a retirement age 66, annual income goals of $85,000 and retirement assets of $800,000. On the left-hand side, we're going to call the first family the Earlies. As you can see, at retirement age 66, they would have Social Security income on an annual basis of $55,800. On the right-hand side, what we'll have is the Laters. The Laters, drawing Social Security at the age 70, have a total annual combined income of Social Security of $73,688. Now, to fund their annual income goal of $85,000, there is a gap. The gap for the Earliers is $29,200, and the Laters is $11,312. Using the formula, again, you're looking at safe withdrawal rates. If we take the $29,200 gap, we divide it by a safe withdrawal rate of 2.4%, their Earliers need to have a nest egg of $1,216,997 to have a high probability of success of reaching their withdrawal rates. Again, that number is $1,216,667. The Laters, who have a smaller income gap of only $12,522, dividing that number by 2.72%, and that withdrawal rate is higher because the Laters are also older, they need to have $460,368 to fund the gap. Now, one thing that you'd also want to take into consideration is what is called the bridge. So in our example, I want to stop for a minute and I want to reiterate the fact that both the Earlies and the Laters are retiring at the age 66. Even though the Laters are not drawing benefits until age 70, in our example, they are both retiring at the age 66. So the Laters, since they're not drawing Social Security benefits, they need to fund the gap with capital to meet their income goals to get them to the age 70. The bridge capital that they need is $352,964. And again, adding the income gap, their total required capital to fund their goals is $813,332. So if we compare the Earliers versus the Laters, you can see that there's a difference of over $400,000 or 33% less with the power of Social Security optimization in our illustration. So you need to plan more heavily weighted in Social Security. If we look at a side-by-side comparison, again, the pre-tax, so income is $93,824, the goal. Subtracting Social Security, withdrawals from retirement accounts, taxable Social Security benefits, what we can see is that there's guaranteed Social Security income is 32% higher, and total taxable income is 52% less. So if you have a question about what we've talked about so far, just shoot me an email at nolan@retirementhq.com, or you can text your questions to 419-909-3828, or feel free to call the office during normal business hours at 419-842-0550. Let's see if you can answer this question correctly. For a married couple, once your provisional income goes above this dollar amount, your benefits become taxable at what point? Answer A is $25,000. Answer B is $44,000. Answer C is $32,000. And answer D is $66,000. All right, do you have your answer locked in? The correct answer is answer C. Now, keep in mind, you'd always want to consult with a tax professional before making important tax decisions. But while we're talking about taxations of benefits, it's also important to understand how the taxation of Social Security benefits work. So let's talk a minute about the term provisional income. The provisional income formula is 100% of modified adjusted gross income plus 50% of the Social Security benefits is how provisional income is calculated. On the right-hand side, then you can see the base allowance or tax thresholds. So in our example for today, using a joint couple, the fourth line down, between $32,000 and $44,000, up to 50% of the benefits are taxable for Social Security. Over and above $44,000, up to 85% of the benefits become taxable. To determine the exact taxable amount of your Social Security benefits, the IRS takes the lowest amount from the following three tests. Test number 1 is 85% of the total Social Security benefits received. Test number 2 is 50% of the total benefits over the amount of the first threshold and under the second threshold, plus 85% of the total benefits exceeding the second threshold. And test number 3 is 50% of the total benefits exceeding the first threshold, $32,000, and 35% of the total benefits exceeding the second threshold above $44,000. So if we looked at before Social Security optimization, the earliers had Social Security income of $61,593 and withdrawals from their IRA of $32,231. They have, in our example here, provisional income of $63,028. Or they have total taxable Social Security benefits of $22,174. After we did the Social Security optimization example, the laters have Social Security income of $81,302, $12,522 as withdrawals from the IRA. Their provisional income is $53,173. So that total taxable Social Security benefit is $13,797. Again, here's another reason why you want to plan more heavily weighted on your Social Security optimization strategy. In a side-by-side comparison of the earliers versus the laters, what you can see is that, again, they have 32% more guaranteed income, plus their total taxable income is 52% less. We're using a 2020 standard deduction with a married couple filing joint. Both spouses are over the age 65, and that number is $27,400. The power of the Social Security, again, side-by-side comparison of the earliers or the laters have a higher percentage of income that's guaranteed. They also have a higher percentage of income adjusted for inflation without market exposure. The income goal that is taxable is significantly less for the laters, and they have higher guaranteed survivor income, and that is assuming no cost of living increases and one spouse passes at the time they elect to begin benefits. So let's recap today's learning objectives. Your situation is unique. There's many factors that go into what could be your family's best approach on withdrawing benefits. The rules and regulations are complicated and mistakes can be costly. As we were going through those questions and we were asking you to answer those questions, if you were not able to confidently answer those questions correct, you could benefit more from being further educated about your Social Security and taking time to understand your options and strategies before starting benefits, because it could make a major difference in your lifetime income. The software that we use, the Social Security optimization software, is a simple yet powerful solution that automatically calculates the scenarios with only 5 to 7 items of information. It immediately demonstrates the impact of various Social Security filing strategies may have on your plan capital requirements, and it can be customized to your unique situation, goals, and desired outcomes. The Social Security optimization software looks like this. You can get an analysis that shows your current plan, Social Security optimized plan, and we can even add alternative plans. So what I would encourage you to do is take the next step. If you haven't yet, email me your questions at nolan@theretirementhq.com, or text your questions to 419-908. Text your questions to 419-909-3828. Or schedule a time to chat with one of our licensed professionals by calling the office at 419-842-0550. There's also an added bonus for listening today, and that's a complimentary dinner gift card. So again, I want to thank you for taking the time to enjoy today's presentation. Normally, we give these presentations during a dinner workshop. It's our way of saying thanks for investing your time today. If you request a time to discuss optimizing your Social Security benefits in the next 48 hours and mention gift card, we would be happy to send you a $50 restaurant gift card. Again, I'm Nolan Baker here at America's Retirement Headquarters. You can find us online at americasretirementheadquarters.com. Thank you again for listening, and this concludes today's presentation.